back. Welcome back to another episode of Take Profit Tuesdays with your boy, Yvonne Stewart, co-founder, host of Vanya FX. And then today, as I always like to start each and every single of our videos, again, guys, this is not financial advice. If you do want to take part in the financial markets, please look for a licensed broker, advisor, someone who is working for an institution that's regulated by the SCE, FINRA. Someone who can definitely take that large sum of money, get some commission off of you, and put your money in the markets and get you some profits. But on this side of the channel, we teach the four pillars: how to invest, how to put your money passively into assets, and to build them. As well as we have other programs that I'll definitely get into. But as I said before, this is not financial advice. So yeah. So as I like to begin every video, for those of you who are just now joining the stream, for those of you who are just now first time watching this, for those of you who've been watching this, I'll start with you first. Let's keep sharing these videos. Let's keep spreading the knowledge. Again, guys, this is one of my passions. This is what I do almost every single week. I think I've been doing this for about 6 months now. I'm gonna keep doing it. It's pretty easy. It's pretty chill. I get to teach you guys some knowledge. We get to build an account together. So, which is kind of what I'm gonna segue next into. As far as this account that we're building, guys, if you're not a part of the group or the team, and if you're just the one that's kind of like just watching this passively, on how to put your mind to basically what the S&P or what we're doing, and to learn how to put your mind to an asset and build it long term, right? I spoke about in other videos that we're going to turn this account into a trading options account, and as far as the amount we're going to set that goal for, I'm not sure as of yet. I think 1,000 just to play with is probably fine. Probably 2,000. I'm not sure. We'll have to see in the near future. In the meantime, what we're doing is investing into the S&P. We're not shorting anything. We're just buying at the most cheapest prices. So now that we're able to buy at the most cheapest prices, as the market recovers, we will gain profit. We will get gains. And those gains will be relatively exponential, relatively great, compared to just, randomly buying it, or let's say buying at the highs almost every single time. We could probably expect to get, let's say, on average, 1 to 2%. We're gonna aim for 5%, 6%, And I remember before. Let me see if I could get my arrow to show you guys. Around right here, at the most recent high from the low, we're about 2% in profit, I believe. And we haven't even touched the highs that we got into before. So, with that being said, actually, we're not even back to all-time highs. So with that being said, and I'm almost confident we'll definitely get back there. We're just kind of fighting this inflation right now, which is a good opportunity to get into good positions for those who are not in it. So this is why I also want to harp on how important it is to, again, share this video, like it, subscribe, get into the masses. One of the best things you could do is like the video, and if you're coming and if you're getting out, just like it. It'll get the video shared to other people, those like-minded like us, and we could earn some money passively, right? And I could give you that education, right? So again, if you haven't watched last week's video, I'll take a look at that as far as what we talked about. And we got a lot of things coming up. A lot. So I just want to clean this up a little bit as far as getting everything live, and make sure everyone's seeing what I'm seeing. So we talked about the Fibonacci last week, right, guys? Oh yeah, by the way, I just want to just put in that at the Vinings Group we have 3 products we offer. We offer the one-on-one training. We do it via Zoom. We have the signal service, and we also have the crypto account management. If you guys want to learn a little bit more of each, send me a message, shoot me an email at stuart.levin@gmail, and yeah, try to reach me and see if we can make something happen. So then now, as far as price coming down, we talked about a couple weeks ago that we expected to react off this zone right here, the golden zone. And I said one of these days I'm going to talk about it a little bit more detail. This is not going to be the video. And we could expect some reaction, a pullback to retest to continue to make higher highs, right? We had a couple rallies for a couple days, which was good. You know what I'm saying? And showed some good signs, right? And then we saw a huge sell-off, and I got to that position. And from last video, and I'm pretty sure from last week, I mentioned that this looked like a W pattern occurring. And from that point on, the pattern still look like it's developing. So if you want to understand candlestick patterns, one thing you have to understand is these hammers represent a lot of buying going on. And even from yesterday, kind of broke that support and it kind of broke those hammers. Nonetheless, let's not forget that even though yesterday's pattern might happen, it could continue to go up. I'm very confident there's a short, a support around the scene. And the best thing about it is that as a long-term trader, you're kind of playing this over time. So we're not really trying to excuse me one second. Yeah, so over time, we're not really expecting price to really break this zone. Now, if it does, that's okay. Because again, we mentioned before, as price keeps getting lower, we're gonna keep on buying at lower lows, and being that we're trading off the daily, we're also forgetting about the weekly and the monthly time frames and how that also has a lot of influence as far as the overall pattern and overall momentum. As far as supports being established, a lot of people may have buy limit orders at these very bottoms, right? Because they're also betting on the U.S. economy to do much better than what it did before, right? So as far as like outlooks and things to expect, and where we could see ourselves in the future, I'm gonna keep this up because again, I want to see most recent all-time highs from August 17th to see how high we could go from there, right? And this may not happen till November, December, if we're lucky, and within October, because we would like to end the year off with some yearly all-time highs since COVID. Well, since that last rally coming down since the war occurred, right? So let's talk about some news. All right, so this one's called "The Fed is not the stock market's friend right now." Morning brief. And shout out to Sam Bro. So he writes, one of the Federal Reserve's most telling statements about the market came from the chair, Jerome Powell, on June 15th, when the central bank announced the biggest rate hike since 1994. Over the course of this year, financial markets have responded and had generally shown that they have understand the path we're laying out. When Powell said that, the S&P had already fallen by more than 20% from January 1st. So, with again, as far as Jerome's Powell jobs, he's not too, how should I say this, fancy. His concerns is not as far as the stock market goes. His concerns as far as how interest rates, how the inflation, how price of goods work. That's kind of his focus. The stock market's probably like a secondary kind of focus right now. So he, like he says, over the course of this year, financial markets have responded and have generally shown that they understand the path we're laying out. So in this statement, he's literally just saying, regardless of how anything has happened, the financial markets have responded and they understand what's going on. So he's already focused in his mind of these rate hikes occurring in the next couple weeks, months, and so on. And we talked about this back in March, back almost the beginning of the year, that the Feds were going to keep raising these hikes, these interest rates. And I believe let's look it up right now. Current, we do this live, guys. Prime. Let's look at U.S. prime rate. So if you Google search the current prime rate, and guys, what the current prime rate is, it's the standard baseline rate that the Feds are lending out the money to banks, creditors, so on and so forth when the money is being printed. And what's important about this, and this was on July 28th, so this was about almost a month ago, right? So whenever the banks, and again, if you guys don't understand how lending works, whenever the Feds lend out money to institutions such as banks or other creditors, they lend them at that rate. So again, if you're a creditor or a bank and you're lending out that money that the Fed's lending to you, you have to charge a higher rate than that. So that the 5.5 is more likely than not your baseline of minimum loans you're gonna give out to that rate. It's probably gonna be 5.275 or 55 or whatever percentage they're gonna have to cut to break even as far as profit. Now, depending on your credit score, now that's another factor. So if you have really bad credit, it could jump up another couple more percentage depending on what kind of loan you're doing, so on and so forth. So just to keep things simple, let's talk about mortgages, right? So if we're thinking about a 30-year mortgage and you want to purchase, let's say, $100K house at let's say 6%, because let's say you have average credit, you're gonna borrow at almost 6%. See, now what this does now, once people are out buying housing, getting out loans, this, that, and the third, what this does, this discourages that kind of spending, because that discourages as far as the buying power. Because again, if you're really trying to buy house, let's say big assets, houses, commercial buildings, so on and so forth, you're gonna buy it at a really, really prime rate, a high prime rate, or a really, really high interest rate. Because again, not only is this going to discourage you, but if you do decide to take on that loan and you have the funds available for you, that funds are going to go back to the government, because again, they're collecting the funds back from the surplus of from the stimulus. So it's very interesting that we're already at 5%. And if you guys can remember, it was about back in 2020, Mr. COVID, we're at